Welcome and get ready to dive into the thrilling world of investments, where numbers dance, money talks, and the unexpected always keeps us on our toes. Choosing stocks that consistently deliver favorable returns year after year is an incredibly difficult task, and most individuals struggle to achieve it. That's why I prefer ETFs, and I think they should be the foundation of most people's investment portfolios. However, in today's video, I will shift the focus to individual company stocks. In particular, if I only get to choose just one stock to buy and hold, this would be my choice. When assessing individual stocks, it's crucial to avoid solely relying on their recent growth within the past 1 or 2 years. Each stock possesses unique advantages and factors that demand consideration when making investment decisions. Thus, in this video, I will present 2 stocks in each category and ultimately narrow down the selection to just a single choice. I will discuss 3 categories of stocks, with 2 top stocks for each category. The first category spotlights growth stocks, which belong to a category that does not distribute any dividends. However, these stocks boast exceptionally high potential for stock appreciation. From a tax perspective, they offer an advantage as your net worth increases without triggering taxable gains or dividend income. Consequently, you are not obligated to pay taxes on those gains until you decide to sell the stock. Moving on to the next category, we encounter a group of stocks that offer a higher dividend but are also projected to have high share price growth. While the growth stocks in the first category may not pay out any dividend at all, stocks in this second category tend to have some dividend yield ranging from 0.5% to 2%. At the same time, their share price and overall stock value are anticipated to grow at an accelerated pace. Lastly, we will explore dividend stocks, which currently enjoy significant popularity, particularly within the YouTube community. These stocks offer substantial dividends, generating a consistent cash flow as passive income. The only drawback is that if you hold these stocks in a regular brokerage account, you will be obliged to pay taxes on the dividends, even if you choose to reinvest them back into the stock. Nonetheless, these stocks are highly advantageous. Let's delve into the growth category, where we find stocks that are purely focused on appreciation. In 2023, there are numerous strong contenders for this category, including well-known names like Tesla, Nvidia, Google, Amazon, and Meta. Among these companies, all of them have experienced explosive periods of returns. However, if I had to choose one, I would select a company whose revolutionary potential cannot be denied. And that company is Tesla. Currently, Tesla is not considered cheap by valuation metrics. It boasts a market cap of $804 billion, with a P/E ratio of roughly 70. The stock's current price stands at $256 per share, with a year-to-date return of 137%. Over the past 5 years, it has seen a staggering increase of 1,022%. These numbers are just astonishing! Traditionally, a P/E ratio exceeding 25 is deemed expensive, so Tesla's P/E ratio above 70 clearly indicates overvaluation. However, when we take into account the qualitative and intangible aspects of what this company brings to the table, it becomes incredibly difficult not to desire a piece of this pie. Tesla is undeniably one of the most popular and innovative automobile brands globally. Their vehicles are truly remarkable, and over the years, Tesla has significantly reduced the prices of their cars, putting pressure on competitors' profit margins. Yet, this is merely a fraction of what the company offers. The most significant advantage they possess is their charging network. Elon Musk has been forming partnerships with other major automobile manufacturers, granting them access to the charging network. This strategic move solidifies Tesla as the standard in the auto industry, a network that everyone must adopt. For many years to come, I can envision Tesla leading the industry. Their full self-driving, or FSD technology, although still in beta mode after an extended period, could become the next major revenue generator, fueling profit margins for years to come. Despite its overvalued and overpriced nature, investing in Tesla for the long term makes sense due to the potential for its price to continue appreciation. Let's proceed to the second stock in the growth category, which is led by none other than Warren Buffett, a legendary investor, exceptional leader, and a brilliant mind in the world of business. This company is none other than Berkshire Hathaway. Berkshire Hathaway holds a diversified portfolio of companies across various dependable industries, with a substantial cash reserve serving as an additional safety net. Over the course of 5 decades, Buffett has acquired approximately 60 businesses spanning sectors like energy, insurance, transportation, and retail. Notable acquisitions include well-known companies like Geico and BNSF. Berkshire Hathaway boasts a favorable PE ratio of 21. The current price of its Class B shares stands at $335 per share. Year to date, the stock has seen an 8% increase. Over the past 5 years, it has risen by an impressive 79%, outperforming the S&P 500 index, which has only grown by 60% during that period. With a market cap of $733 billion, Berkshire Hathaway's track record speaks for itself. Remember, the idea here is to choose a stock for a long-term investment. While other picks may seem more enticing, given Berkshire Hathaway's remarkable track record, it is certainly worth considering. Now, let's move on to the next category, the middle ground. In this category, we find stocks that offer a moderate level of dividends along substantial share price appreciation. These stocks are often categorized as high-growth, low-dividend stocks. In the realm of many exceptional companies in this category, the first pick is an easy choice. It happens to be the largest company in the world in terms of market capitalization, valued at nearly $3 trillion. And that company is Apple AAPL. The reason behind choosing Apple is rooted in my belief that it will remain a dominant force for an extended period. Apple is more than just a technology company. It generates revenue from multiple products and asset classes. It has cultivated a dedicated customer base that exhibits fierce loyalty, and its commitment to innovation continuously enhances lives through its latest offerings. The company operates exceptionally well, and its brand is renowned and adored worldwide. Apple currently boasts a PE ratio of 32. The stock's current price stands at $186 per share. Year to date, Apple has been performing outstandingly, with a remarkable 49% increase, and over the past 5 years, it has delivered a staggering return of 303%. While its dividend yield may not be enticing at 0.51%, it is important to note that regardless of the category it falls under, Apple is undoubtedly a top contender when considering a stock for long-term investment. Moving on to the next pick in this category, we encounter another technology stock with a consistent track record and a promising future. It is deeply involved in the 2023 craze surrounding artificial intelligence. The company in question is Microsoft, MSFT. With a market capitalization of $2.5 trillion and a PE ratio of 36, Microsoft's current price sits at $335. Year to date, the stock has delivered an impressive 39% return, and over the past 5 years, it has surged by 240%. The dividend yield for Microsoft is slightly higher than Apple, at 0.81%. Notably, Microsoft has exhibited consistent dividend growth over the past decade, which is an exciting prospect for investors like myself who appreciate rising share prices and increasing dividends. The company holds significant brand power, particularly with its renowned offerings like Microsoft Office and Windows. Additionally, Microsoft is making significant strides in the gaming and metaverse sectors. Looking ahead, Microsoft has positioned itself exceptionally well in cloud computing and the AI space, which are anticipated to become fundamental components of future operations. Its Azure and ChatGPT platforms boast a substantial user base, and Microsoft has already invested a substantial $10 billion in this technology, positioning itself as a leader in this category in the long run. Now let's turn our attention to the final category, dividend stocks. The goal of investing in this category is to secure a consistent cash flow and passive income for the long term. When selecting a stock within this category, it's crucial to choose a company that is highly sustainable and poised to endure indefinitely. The focus here is not solely on finding the highest dividend yield for a year or two. Instead, the objective is to identify a stock that can sustain and potentially grow its dividends each year indefinitely. Some noteworthy contenders for this list include McDonald's, Johnson & Johnson, AbbVie, and Pfizer. Among these options, my personal favorites are Coca-Cola and Procter & Gamble. Both of these companies are renowned household names with extensive histories of dividend growth. Coca-Cola, for instance, has been consistently paying dividends since 1964. As of the time of this video, it offers a dividend yield of 3%. Procter & Gamble, while boasting a slightly shorter dividend history dating back to 1972, currently offers a dividend yield of 2.52%. Needless to say, both companies are well managed and possess a deep understanding of efficient capital allocation. In terms of performance in 2023, both Coca-Cola and Procter & Gamble have experienced a decline of approximately 2%. Coca-Cola has a PE ratio of 27, while Procter & Gamble's PE ratio stands at 25. Although they may not be the hottest stocks making daily news headlines, they are incredibly safe and established dividend kings that many institutional investors, including Warren Buffett, appreciate. Berkshire Hathaway's latest 13F filings reveal that Coca-Cola remains one of Buffett's top picks, reaffirming its stability and appeal. So here are the top 2 candidates in each category: the growth, the dividend, and the in-between. If I were to choose just one company stock to buy and hold forever, I believe it would be wise to select a company that doesn't rely solely on technology. This means ruling out Tesla, Apple, and Microsoft. While safe and stable companies with attractive dividends have their merits, I also desire a company that offers greater potential for overall growth, considering I have ample time before retirement. Consequently, I would eliminate Coca-Cola and Procter & Gamble from the running. This brings us to the final pick, Berkshire Hathaway. This choice aligns with the fact that Berkshire Hathaway possesses strong leadership, a competitive advantage, and diverse revenue streams. While there may be concerns regarding the ages of Warren Buffett and Charlie Munger, it is worth noting that Buffett excels at mentorship, even more so than investing. He has been grooming his successors at Berkshire for over a decade, involving them in recent activities and entrusting them with significant portions of the business to ensure a seamless transition. And with that, we conclude our rundown of top stocks for long-term holding. I hope you found the content enjoyable. Please leave your comments below regarding your favorite stock. Make sure to watch the video now to help you progress on your journey towards financial freedom.